All right, let's dive right in. We're taking a look at the Kinki Region's new condo market for December 2025. And wow, the numbers are telling a really fascinating story. We're talking surging supply, incredibly strong demand, and a very surprising twist when it comes to prices. Hello, and welcome to the Japanese Economic Review channel. We're the place that makes sense of all this complex economic data. So let's get straight to the most dramatic number from this month's report, shall we? So the very first thing that jumps out is this number right here. A massive 36.6% year-over-year surge in the supply of new condominiums. I mean, that is huge. It's the highest level we've seen since December 2023. And honestly, it's the key to understanding everything else we're going to talk about. Okay, so here's how we're going to break it all down for you. We'll start with the highlights, then dig into where that huge supply surge is coming from. We'll check in on whether buyers are keeping up, solve a really interesting price paradox, and then we'll look ahead to what 2026 might have in store. All right, let's kick things off with the big picture. What were the main headlines for the market back in December? Well, it really boils down to three key themes. Okay, so here are the core themes for you. First, supply is way up. We're talking 3,283 new units hitting the market. But, and this is the interesting part, despite all that new supply, buyer demand is incredibly strong. You can see that with a 75.3% contract rate. And here's the real puzzle, the one we're going to unpack. While the price per square meter actually hit a record high, the average price for a whole condo went down. Yeah, weird, right? We'll definitely be coming back to that one. So let's take a closer look at that huge increase in supply. Where exactly are all these 3,283 new units coming from? Well, it turns out this supply surge is highly concentrated. If you look here, Osaka City and Kobe City alone account for more than half of all the new units. So it's pretty clear that developers are really focusing their efforts on these major urban centers. Now, with all those new units flooding the market, you might expect demand to soften a bit, right? But the data shows the exact opposite. Let's get into why a 75.3% contract rate is such a powerful signal of a healthy market. You know, in the real estate world, a 70% contract rate is kind of the magic number. It's the benchmark for a healthy, thriving market. In December, the rate was 75.3%. That's not just a pass, it's an 11.6-point jump from last year, and it's the first time we've cleared that 70% benchmark in 2 months. So yeah, buyers are definitely out in force. And the demand isn't just strong, it's intense. Get this, 6 entire properties, that's 138 individual units, sold out on their very first day of sales. Just gone. What's more, over 1,000 of the units sold or specifically investment properties, which shows a ton of confidence from investors, not just regular home buyers. Okay, this brings us to what I think is the most fascinating part of this month's report. I'm calling it the price paradox because it seems totally contradictory at first glance, but the data doesn't lie. Here it is laid out in plain numbers. The average price you'd pay for a whole condo actually fell, just slightly. But at the exact same time, the price per square meter, which is the real measure of value, shot up by 8% to a record high. See what I mean? It doesn't seem to add up. So that's the big question, isn't it? How on earth is this possible? How can the total price go down while the value of the space itself goes up? Let's solve this puzzle. And here's your answer. The average size of a new condominium sold this month was just 53 square meters. The units themselves are getting smaller. So here's the crucial takeaway. The market is shifting. Developers are building smaller, more efficient units, probably catering to single buyers or investors. This means buyers are paying less on average, but that's simply because they're buying less space. At the same time, they're paying an absolute premium for every single square meter they do get. This trend toward dense, high-value urban living is exactly what's pushing the underlying value of property to record levels. So, after all that, what does this all mean for the market as we head into 2026? Let's look at the forecast. The official forecast is anticipating around 800 new units for January 2026. Now, if you look at the historical data, this suggests we're getting back to a more stable, typical supply level after that big December surge. It's basically continuing a gradual upward trend for January releases over the past few years. So if we had to boil down the state of the market into one single sentence, this would be it. We've got a market defined by a huge influx of new properties, buyers who are more than ready to absorb them, and a fundamental shift in what those properties look like. They're smaller, pricier per meter, and increasingly located in prime urban centers. And that really leaves us with a big question, doesn't it? Is this trend towards smaller, more valuable units just a short-term reaction, or is this the new long-term standard for the Kinki region? Definitely something to keep an eye on. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.